Hey, welcome back everyone to the Real Money Pros. I'm Nick Daniels, and today we're gonna talk about net unrealized appreciation. If you own company stock inside of your 401k, this video is specifically for you. First of all, let's give you a quick refresher on what happens normally when you're doing a 401k rollover. Now, you got your 401k account. Let's just say you got $1 million in your 401k. First of all, great job. And maybe you've got some in a target date 2025 fund, maybe some in a fixed income fund, a large cap fund, a blended fund, and you go to retire. Now, what usually happens is all of these, right, you're gonna give the instruction, these are all gonna sell to cash. And the reason for that is that when you're doing a rollover to the IRA, oftentimes the custodian where you have your rollover IRA is not gonna hold these funds. Sometimes these funds are just very, very specific to the plan. So you're gonna sell these things to cash, and then you're gonna bring it over to here, and now you're gonna have $1 million in your IRA that you're going to get invested. Well, remember, let's just say that in retirement, hypothetically, let's say that you're at a 22% income tax bracket. So as you're pulling money out of this IRA, you're paying 22% to the federal government in income tax. And you know that, that's how a rollover works, right? We accept that. But if you have company stock inside of your 401k and you can track the basis, now you want to talk about doing this net unrealized appreciation. Let me show you how this works. So let's say that today's value of your company stock is $200,000. Let's just say that your basis, let's use $40,000 because you were able to buy it at a discount. Good for you. When you go to retire, here's what you want to do if you want to take advantage of net unrealized appreciation, and here's why you would want to take advantage of it. You go and do a rollover. Well, out of your 401k, you can take your various mutual funds. Let's say it's equal to $800,000 of your total of $1 million in your 401k. These mutual funds, again, you're gonna sell the cash and you're gonna do a direct rollover of that portion to your rollover IRA. So you'll end up with $800,000 over here. And again, let's just say that you know you're gonna be paying a 22% income tax as money is coming out of that IRA. But if you can track your basis on this company's stock, here's something very, very cool. You take this $200,000 of company stock and you want to distribute 100% of your shares into this non-qualified brokerage account. And let's say this basis is on 100 shares. If you do a direct distribution of 100% of your shares, so in this scenario, 100 shares into this non-qualified brokerage account, you're gonna end up with still 100 shares of your company stock over here. Now, what's the tax implication on it? The tax implication is as soon as you do this direct distribution to the non-qualified brokerage account of your 100 shares, you're gonna have to pay income tax on the basis, $40,000. So over here, you'll end up in this non-qualified brokerage account, you'll have 100 shares at a $200,000 market value, but you're gonna pay 22% income tax on the basis to get it into this account. And again, your basis in this example was $40,000. So 22% tax on the basis, you're paying $8,800 in income tax on the basis. Now you still have $200,000 market value of your shares of company stock in this non-qualified brokerage account, and now you can do whatever you want in that account. And whenever you go to sell some of these shares, you're gonna be taking them out at long-term capital gains. Again, if you're in this 22% federal income tax bracket, your long-term capital gains most likely, as you sell shares to fund your retirement, will be taxed at long-term capital gains, which are probably for you gonna be 15%. Do you wanna pay 22% on $200,000, or would you rather pay a 15% tax rate on $200,000? But again, you can only do this if you have company stock and you can track your basis inside of your 401k. You're paying income tax on the basis. That was your tax deferred income that went in to buy the stock all throughout the years as you working for the company. You fully distribute 100% of your shares to a non-qualified brokerage account. So you're still left with the same amount of shares, the same market value in your non-qualified account as what the market value was in your 401k. But you're gonna pay income tax on the basis, which in this scenario is way less than paying 22% income tax on $200,000 if it was sent straight to your rollover IRA. And now you can continue to hold on to these shares as long as you want. When you sell them and get the cash, you're paying long-term capital gains at 15%, which is far more favorable than a 22% tax rate. Again, you have to have company stock that you purchased inside of your 401k, and it only applies to your company. So let's just say in this example, I work at Costco and I'm buying Costco stock inside my 401k and I can track my basis, then I can take advantage of net unrealized appreciation when I retire, and I can distribute my Costco shares to the non-qualified brokerage account. I send all my mutual funds to a rollover IRA, and now a significant portion, 20% of my 401k's value is going to get taxed essentially at 15% instead of 22%. It's a very tax efficient move for people who own company stock inside of their 401k. If you've got questions about this, send us an email. Go to our website, therealmoneypros.com, click on the Ask the Experts feature, and we can help you run the numbers to see if taking advantage of net unrealized appreciation is going to work in your favor.